This video is an urgent warning for all investors that it looks like we are on the precipice of a global margin call. I do not like making videos like this where I'm giving an urgent warning about something happening in a very short time frame, but there are just too many warning signs happening, flashing red right now for me to ignore. So first, what is a margin call? There are three things necessary for a margin call to happen. Number one, you borrow money in order to buy something. Then that thing that you buy goes down in value. The third thing that happens is that the person you borrowed money from to buy that thing forces you to sell that thing so that you can pay them back the money that you borrowed. The moment that they force you to sell to pay them back, that is the margin call. And while the tightening over the last couple of years has been nothing compared to the easing they've done in the past, it is undeniable that their balance sheet is absolutely moving lower. The last time it was this low was July of 2021. While the Federal Reserve's balance sheet would like to disagree. Seeing as how the balance sheet is worth about $8 trillion right now, the Federal Reserve has quite a bit of US treasuries, and they are not on net buyers of these treasuries right now. When the Fed's balance sheet is declining, that means they are letting these assets bleed off their balance sheet, aka they are letting some of these is purchased on margin to a greater extent than equities. That's right. If you're buying things like bonds or treasuries, you can use leverage to buy that debt. And yes, debt itself is leverage. So you can use debt to buy debt. This is debtception or leverageception. So debt markets around the world are much more highly leveraged than equity markets are. And these financial institutions right now, especially the ones in Europe, are not in the best shape. Their balance sheets are in trouble and they're holding a lot of assets that are underwater. They're in way worse shape than American banks. And in March, some of the American banks even started to fail, which means at any moment there could be a catalyst that some of these financial institutions around the world will be forced to liquidate their assets, which is distressed debt, in a scramble for dollars, which are just dollar IOUs. And the real trouble here comes from major financial institutions, especially banks that deal in dollars all around the world are dealing in something called the Eurodollar system. Now, I've made in-depth videos about the Eurodollar system before, but Eurodollar is a bad name. Really, the Eurodollar system is any time outside of America there's a financial institution with a dollar IOU. Now here's how that happens. When anybody in the United States purchases something from another country, we send a dollar to the bank account of the person we're buying that thing from. So now there's a dollar overseas that exists outside the scrutiny and the oversight and the regulation of the Federal Reserve. Now that dollar is an asset for that bank, and so that bank can make a loan on that dollar. So that bank with that dollar makes a loan, and that loan is dollars that land in somebody else's bank account. But there's a bigger player than China, and that's Japan. Japan currently has $1.1 trillion worth of US treasuries. Unfortunately, Japan is in a very similar economic situation with a massive whopping 260% debt to GDP ratio. Their currency versus the dollar is also collapsing. Meanwhile, they're trying to get out of yield curve control, which is something they've been trapped in for a long time now. They're also dealing with a population implosion, and this $1.1 trillion worth of assets is looking pretty juicy to Japan right now as a slush fund to start to sell, which is something they've already been doing. In the year 2022 alone, they dropped from 1.3 trillion of US treasuries down to 1.1 trillion of US treasuries. So outside of the US, the largest holder of US treasuries, Japan, and the second largest holder, China, are both selling. Big money selling, pushing prices down, catalyst for rates going up. But that's not all. This is why it looks like interest rates are about to break out to a multi-decade high, as bond prices look like they're ready to fall off a cliff. Debt markets are the most over-leveraged markets in the world. What happens when that risk-free asset falls to a price below the point at which the lender is comfortable with you hanging on? Well, you get forced to sell. And when everybody starts getting forced to sell, that pushes prices down even more, which means everybody else also starts getting forced to sell as well. You get a stock market crash right at the same time as you get a bond market crash. With equity markets being near all-time highs, many investors still have gains in many stocks, especially tech stocks, which means that a forced sell-off in bonds could absolutely easily trigger a crash in equities. Now I'll give you, if an investor had decided to buy Coinbase instead, and they waited for the initial sell-off, and then upon the next rally they thought that all the selling was done, they decided to load up with leverage and buy shares of Coinbase on margin at $350 per share. At some some point as the stock fell, their broker would have called them and forced them to sell the stock. One hand in the air for the big city. Street lights, big dreams on the